Good evening, everybody. It's 5 after, so we'll get started with the presentation. As you know, tonight's topic is HST and real estate. So first, a disclaimer. Essentially, this is presented as information and not to be taken as tax, accounting, or legal advice. Things may change because of a new court case or a new law that could come out tomorrow, and I'd have no way of knowing that, of course. So just take it for information. So what we're going to cover tonight is HST, how it applies to income and expenses, purchase and sale, primary and secondary intent or purpose, rebates, and a Q&A period. If we have time, I have a bonus topic I'd like to cover later. So what we're not going to cover is bare trust issues as they relate to HST. Quick introduction. My name is Michael Matthew. I've been a professional accountant for more than 30 years, the last 10 or so of which have been increasingly focused on real estate investors. I also work with American CPAs to deliver comprehensive solutions that help people that invest in the US. So I provide the following services: assistance with US investments, entity structuring or setting up corporations in Canada and the US, operational consulting, tax planning, and tax return preparation for both countries. I also hold a CFO position with a local home builder. I'm an investor myself. I own a nearby condo, and I'm also looking for a small apartment building in Texas, initially in the Houston area, because of the greater returns available. In terms of our plans for the group, the plan is to meet once a month on the last Thursday of the month at 7 p.m. I will be delivering most of the content, and we'll address various issues related to real estate, including additional considerations for investors with U.S. properties and accessing other allied professionals. Happy to take your suggestions. If you would like to have some more detailed questions answered or have something you'd like to discuss one-on-one, please schedule a free consultation. And here's the link there where you can do so. Appointments are available in that hour and a half hour tomorrow from 2 to 4. And in this case, it'll be Tuesday because of the holiday on Monday that most of us will be having. So starting off with HST on income and expenses. If you provide only exempt goods and services, you cannot register for HST. So this means you don't charge HST on your goods and services, and you do not claim input tax credits. Input tax credits are simply the HST that you paid on your various expenses. Specifically in terms of real estate, long-term residential accommodation, 1 month or more, are what are called exempt supplies. So what this means is if the only source of income you have is from residential real estate, you can't legitimately register for HST, and therefore you can't claim input tax credits. If you do happen to get registered, eventually CRA will revoke your registration, and any HST input tax credits that are paid out to you will have to be repaid. So it's definitely not worth doing. In terms of charging HST on income, you'll charge it on commercial rent. So, rent to manufacturers, offices, retailers, restaurants, etc. flips of pre-construction condos unless you have reasonable justification for the change in plans to reside there. Short-term rentals like Airbnb or VRBO, which is vacation rental by owner, if it's for less than 30 days in a row. So again, all of these are where you will charge HST. And when I say HST, I'm just using that as a shorthand to refer to either HST or GST, depending on where your property is located, because different provinces have different tax schemes. Some have harmonized sales tax, some only have GST. So you will not charge HST on the following income: residential rent for terms exceeding 1 month, as we talked about earlier. In terms of expenses, you'll pay HST on the following: advertising, commercial condo fees, so again, not residential, office expenses, professional fees, property management fees. So professional fees, your lawyer, your accountant. You also pay on real estate commissions, repairs and maintenance, travel expenses, utilities, except for water bills, interestingly enough. Now, there's no HST on the following: insurance, interest and bank charges, mortgage or line of credit interest, property taxes, that should say, and as I mentioned, residential condo fees. Salaries, wages, and benefits if you have employees. Again, you won't pay HST on that. If you are able to deduct motor vehicle expenses in relation to your real estate business, you'll pay HST on fuel and oil, on lease costs, maintenance and repairs. You will not pay HST on the following: CCA, which is the tax term of capital cost allowance or depreciation, insurance, interest, license and registration, toll fees. So now we're going to talk about HST on the purchase and sale of real estate. So as a starting point, interestingly enough, HST applies to all sales of real estate. However, there are several exceptions, the most important one of which is if you're reselling of a residential property. Note that this also applies to the purchase of a substantially renovated home, in that HST will apply in that situation. CRA has a bulletin which defines what a substantial renovation is in their mind, which is at least 90% of the interior of a building has been removed or replaced. So there is some wiggle room on that, obviously, but for most people, unless they're doing a complete gut of the interior and rebuild, you're not going to come close to 90%. So it'd be more in the case of where you're buying a home and knocking it down and building, then that would definitely apply, or as I said, a complete gut job. If it's a commercial purchase, so you're buying commercial real estate, HST will apply. However, typically buyers who have an HST registration prior to the closing will not need to pay HST on the closing, provided that they have that registration and they sign an appropriate undertaking to self-assess the HST. And usually the way that works is you report the HST as paying it and you claim an input tax credit all in the same document. So the net effect is there's no out of pocket on it if you follow these rules. Occasionally, there's a mixed-use building. A mixed-use building is one where there's both commercial use and residential use. So in that case, you have to split the purchase price between the two parts of the building, part that is residential and therefore exempt, the other part that is commercial, which will then attract HST. Typically, that's done on the basis of square footage or a similar measure. In case of vacant land, no HST is payable if it's an individual who sells personal use vacant land. So with the fix and flippers, if you're registered for HST, you'll be able to claim all the HST you paid on the renovation materials and services as input tax credits, which are deducted dollar for dollar from any HST you have collected on the sale. You'll get a refund if your ITCs are more than the HST you owe, which would be unlikely unless you're filing multiple times throughout the year and before the deal closes. Understand that I can assure you, given that I'm a CFO of a home builder, that the agreements of purchase and sale will almost always state something like, if HST applies, it is included in the price. So you need to include a clause stating this is conditional on the assigner's lawyer's approval. HST will be payable by the initial buyer / assigner on the entire sales price. The assigner must report any profit realized from a sale in the year in which the right is assigned. Profit will either be treated as fully taxable business income or as income from a capital gain, only 50% of which is taxable. And we'll get into more detail later about how that is determined one way or the other. So a bit of background: where a person enters into a purchase and sale agreement with the builder for the construction and sale of a new home, the person may be entitled to assign those rights and obligations to another person, which would be an assignee. Generally, the result of the assignment is the purchase and sale agreement is then treated as if it was between the builder and the assignee, or the second purchaser, if you will. So here's a situation where a purchaser enters into an agreement with the builder for the construction and sale of a new home. They then assign the agreement before possession or ownership is transferred to them and before anyone has occupied the home as a place of residence. For GST or HST purposes, the assignment of the agreement is normally considered to be a sale of the first purchaser's interest in that home, which is generally taxable where the person selling the interest is a builder of the house. Taxable, I mean, for HST purposes. So that brings us to what's a builder for HST. Includes a person who is in the business of constructing or substantially renovating houses for sale. The house may be on land owned or leased by that builder. So that is the traditional definition of a builder, and I think everyone understands that. However, when it comes to HST, the definition of a builder does not stop there. A builder may also include a manufacturer, vendor of a mobile home or floating home, i.e. houseboat, that sort of thing. A person who buys an unoccupied new home for resale. A person who inquires an interest in a home while the home is under construction or substantial renovation and completes it, so they finish it themselves or engage another person to complete the construction or substantial renovation. So in either case. A person who converted a non-residential property into a house without substantially renovating the property. So some of the office buildings that are vacant in downtown areas are being converted into residences. So that could be an example of this. However, a builder does not include an individual unless they acquire, build, or substantially renovate housing or hire someone else to build or substantially renovate housing. In the course of a business or an adventure concerned in the nature of trade. So these are tax phrases: adventure, concern in the nature of trade, simply to address the situation where it's more of a one-off situation, not something where a person does this on a regular basis. For example, someone who buys, builds, or substantially renovates a home to use as their primary place of residence is generally not a builder of that house for GST purposes, which means they don't have to pay HST on the home they're building for themselves. Nor does a builder include a person hired to provide construction services on land that is leased or owned by someone else and who does not have an interest in that land. So again, they're not considered to be a builder. This is where it can get confusing because they're actually doing the construction work. So people may easily think they're the builder. They are in terms of the physical world, but not in terms of HST. Again, a contractor could be hired by an owner to build the house or substantially renovate an existing house. They're not considered to be a builder of the house. Again, we're talking for HST purposes. Whether HST applies will depend on the original intention, as does capital gain or business income treatment. If you had a primary or secondary intent at the time of purchase to flip the property, HST will apply. CRA will consider a number of factors to try to determine your intent. So look at it from a couple of perspectives, being the assigner and the assignee. So the first question is, did the assigner meet the definition of builder for HST purposes, which we just covered? And did the assigner intend to purchase the property for business purposes? In many cases, the assigner of the property may be deemed to be a builder under the Excise Tax Act. And Excise Tax Act is simply the act that governs the application of HST. If the assigner can demonstrate to CRA their intention when they put in an offer to buy the property was to use it as their primary place of residence, then when they assign the contract, they'll be exempt from paying HST on the consideration received. And we'll have some examples in a minute or two that will help us better understand how this can be the case. On the other hand, if the assigner enters into the contract with the intention of leasing or reselling the property at a profit, then they will be required to collect and remit tax on the total amount charged to the assignee, which includes any markup earned through the assignment as well as any compensation for deposits already made under the agreement of purchase and sale. So some people think that, well, it's not taxable at all, or if it is taxable, it's just on the spread between what their contract says. So let's say the contract said it was $500,000, they sold it for 100,000 extra, then that 100,000 is the only part that's taxable. If they also are getting compensated for any deposits they made along the way, there will be HST on those deposits. As a starting point, under most new construction agreements, as I mentioned earlier, the assignor will qualify for the new residential housing rebate, because the operating assumption among builders is always, always the purchaser intends to use the home as a place of residence. However, once they assign that contract, their eligibility for this rebate is forfeited because they're no longer taking title to the home. It's also important to understand there can only be one new residential housing rebate application filed per dwelling. In other words, the original buyer or the assignor and the second buyer or assignee, it's not a case where both of them can get the rebate. So it's incumbent upon the assignee to determine whether the rebate is still available to them. And so they will need to meet the same requirements that the original buyer would, and they may have to make separate arrangement with the builder to make sure they have the rebate amount credited at closing. It's a good idea for the assignee to provide a declaration to the builder that they meet the requirements for this rebate and get it in writing that the builder will give them that credit. And then it solves a lot of disputes down the road. There's also the responsibility in the builder to make sure they understand what the buyer's intentions are before closing, because if they give the buyer credit for the rebate when the buyer intended to rent the property all along, it creates problems for everybody. Now, there's also a second rebate called the residential rental housing rebate, which is applicable when you're purchasing the property for a long-term rental as a place of residence. In this case, however, if the intention is to rent it, you likely will have to pay more than the original contract called for, because you cannot get that rebate credited to you by the builder at closing. You have to pay it in advance and then get the rebate after the fact. When it's an assignment sale, the buyer of a property is assigning all the rights and obligations of their contract to a secondary buyer. So this will create a profit, which is taxable as business income in the year in which you assign your rights. So if it's a pre-construction condominium, for instance, where it may be 3, 4, 5 years between the time you sign the original agreement of purchase and sale and the actual closing, you could assign it, let's say after 3 years, you have to report the profit in year 3, not in year 5, when it actually becomes available to be occupied and ownership is transferred to the new buyer. So we talked briefly about the flip situation. I just want to remind people that the fact you're living in a property while making improvements does not entitle you to claim the principal residence exemption on that property, because the intention was always to buy, improve, and sell. So any profit has to be reported as business income. In other words, 100% taxable. Similarly, when you're buying vacant land and building a property, which is then sold, or buying a house, which is significantly renovated or demolished and replaced with a new build, if you're living in the property while making those improvements, again, you're not entitled to claim the principal residence exemption, because your intent, and we'll talk about intent several times tonight, was always to buy, improve, and sell for a profit. So again, any profit made must be reported as business income, fully taxable. We're going to talk now about primary and secondary purpose or intent. CRA looks at a number of factors. They say none's more important than the other, although I have my doubts if all of them line up on one side, your side, and one factor lines up on their side, they'll say it's the most important factor ever. But anyway, so there's a number of factors that should be considered to determine the person's purpose. And there's a related concept of business income versus capital gain. And why that's relevant to the discussion of HST is if it's business income, then typically HST will apply. And if it's a capital gain, HST often will not. So that's why we'll be looking at some information about that distinction as well. So the following factors may indicate for HST purposes, a person entered into an agreement for the primary purpose of selling an interest in the new house or the house itself. So the first one is the person offers to sell their interest in the house or takes other actions to attract buyers before or while the house is under construction. Obviously, if you're trying to sell something before it's been built, then you were never intending to stick around and have that as your residence. Another factor is the person finances the purchase by a short-term mortgage, perhaps a year, or an open mortgage that can be paid off without penalty, rather than by a long-term or closed mortgage. Another factor is financing the house is beyond the person's means, and that person is relying on the increased value and saleability of the house in a rising housing market. This is especially the case where one person has purchased 3 condos at the same time from the same builder. Obviously, they can't live in 3 different places. And this next one is just what I was referring to. Person's individual and their stated intention to occupy the house as a place of residence is not supported by the circumstances of the case. For example, if an individual has a family of 4 and enters into an agreement for a purchase of a 1-bedroom condo, when they're not contemplating any changes in the family circumstances. So unless you have 2 children that are about to go off to college or university, and then buying a 1-bedroom condo isn't going to be believable as you indicating that you will reside in that condo once it's available. Another factor is the pattern of activity is such that the occupancy of the house does not have the qualities or characteristics of being permanent. And this is when they're buying more than one house at or around the same time. Perhaps they can, as mentioned earlier, they can claim that principal residence exemption as they lived in it and fixed it up. But again, that wouldn't apply. This factor is also given extra weight when you've previously entered into agreement of purchase and sale for the purposes of selling the house. In other words, if you've bought and resold or flipped properties before, there'll be a presumption that that's what you're doing this time as well. Another factor is, are there any outward indicators to support a contrary primary intention? So if there's nothing to indicate that you aren't going to resell, that will also be factored in. For example, if you're selling a condo, one or more of those factors are present. There's no evidence that the individual's primary intention was to live in the condo unit or use it as a vacation home or rent it to another individual, and no evidence that the sale of the condo was triggered by some unforeseen event. We'll get into some examples of an unforeseen event in a few minutes. In order for the acquisition of an interest in a new home to be one of those purposes we just reviewed, the intention to sell the house must have existed at the time of acquiring the interest in the house. However, the intention at the time of acquisition may be demonstrated over a period of time. In other words, CRA will look at not just what was going on at the time of the purchase, but subsequent to that purchase. Another factor is if an individual acquires an interest for the primary purpose of using it as a residence, the person is not considered to be a builder, even if at a later point they sell the house or an interest in the house. So the fact that you sold the home down the road doesn't mean you're automatically a builder. Again, when we say builder, we're talking about for HST purposes. And there's a definition that we already looked at. So now some examples. So we have three people that are roommates. They're renting a 3-bedroom house. They enter an agreement for a 1-bedroom condo in a new complex that was to be built, and the purchase price on the agreement was $300,000, closing in about 3.5 years. So 3 people in a 3-bedroom house, 1-bedroom condo. So partway through in March, the fair market value of the condo unit increased by 50%. Several offers were received before they assigned it to someone else. No one has occupied the unit because closing hadn't occurred. They split the proceeds and each party used those as a down payment. So this is very much a money-making venture for the 3 roommates. In this case, there's no contrary intention. They got several offers. They're considered to have acquired their interest in the condo for the primary purpose of selling it. That means that they're all builders of the condo unit for HST purposes. And this is the phrase that we mentioned earlier, to be in the course of a business or adventure concern the nature of trade, a one-off. So even though they're not home builders on an everyday basis, for HST purposes, they are considered builders in this case, which means they have to charge HST on that assignment. Another example. So I have a couple that own a 4-bedroom house where they live with their 3 children. They enter an agreement to buy a 1-bedroom, and about a year later, they sell their interest for $400,000, $125,000 profit before it had been occupied by anyone. So although they had no history of buying and selling real property, it would not be practical for their family to occupy the condo unit as a place of residence. Without any evidence to the contrary, their primary purpose in acquiring the interest in the condo is to be considered for the purpose of selling it. Accordingly, they are considered builders of the condo for HST purposes. Given that their interest is not exempt, HST applies to the sale of their interest. So another example of a couple with a 3-bedroom home where they live with their 3 children. They entered an agreement to purchase a new 4-bedroom house that was to be built. It was located much closer to the children's school and to the couple's workplaces. They sold their home and moved into rented home that they planned to live in until their new home became ready. However, at a certain point, Gina's mother became ill and moved in with them because she could no longer live on her own. At this point, it was decided the new house would no longer be large enough and they would need a home with a granny suite, which is a secondary suite often located in the backyard. And they sold their interest in the new 4-bedroom home so they could buy a bigger one that would suit their new needs. Their primary intent when they sold the original home and temporarily moved to a rented home during the construction phase of their new home was to support their intention in acquiring that home to use as their primary place of residence. So in effect, their actions were consistent with what they were saying. Given this and the fact that their only reason for selling the interest was due to a change in personal circumstances, i.e. the new house would no longer accommodate their family's needs, they are not considered to have acquired the interest in the house for the primary purpose of selling it. Accordingly, they are not builders of the new house for HST purposes, and the sale of their interest is exempt. So this is one example where, because of their original intention was to stay in the home, there's no HST, even though they sold it before it was even built. Another example, Cindy enters into an agreement for a new home to be constructed. Her new home would be located within walking distance from her work and be closer to her family. However, the next year, Cindy's employer announced it was relocating to another city located 3 hours away. To keep her job, Cindy had to move, so she sold her interest in the house. Since Cindy had intended to use the house as her primary place of residence, and her only reason for selling her interest was due to work relocation, she did not acquire the interest in the house for the primary purpose of selling it. Therefore, she is not a builder of the house for HST purposes, and the sale of her interest in the house is exempt. Turning to the assignment fees, the consideration charged for the sale of an interest in the house generally includes amounts the person paid to the builder as a deposit. And that person will want to recover that when assigning their interest in the house. The sale price will almost always include a profit, which would be an amount over and above the amounts paid to the builder. If the sale of the interest to an assignee is taxable, and we saw some examples of where it was and where it wasn't, the total amount payable for the sale is subject to HST, including any amounts paid as deposit to the builder, whether it's separately identified or not. Last example, first purchaser enters into an agreement, pays a deposit. The first purchaser doesn't make any other payments, and they assign the agreement for $5,000 more than they placed as a deposit. If the sale of the interest in the house from the first purchaser is subject to HST, and again, that goes back to the intent as we looked at, the tax applies to the full 15,000. So this is just putting some numbers to what we talked about. This is the case even if the assignment agreement identifies the $10,000 is in fact a recovery of the deposit. Note that the builder will often charge a fee to the first purchaser to allow the assignment, and that is typically listed in the agreement of purchase and sale. If there is no reference to it, you can still assign it. It just, you may get some pushback from the builder. If they charge you a fee for that, typically there'll be HST on that fee. So we're going to talk a little bit about characterizing the gain on a sale as either business income or capital. And again, why that's relevant is if it's business income, typically HST will apply. And if it's capital, in other words, a capital gain, HST will typically not apply. And so there, again, there's a number of factors. We looked at intent, the extent to which the intent was carried out. Any evidence the intention changed after the purchase of the real estate. And we saw some examples earlier. The location and zoned use of the real estate. So obviously, if it's a commercial only property, you can't claim that you are going to use it as a residence. The nature of the taxpayer's business. In other words, the closer your business is to real estate, the more likely it's to be considered to be business income and therefore taxable. The extent to which borrowed money was used to finance the acquisition of the real estate and the terms of the financing arranged, if any. The length of time the real estate was held. So I had a client who advertised properties for sale within a few weeks of buying them and tried to claim capital gain treatment. Obviously, that was not realistic in the scenario, and he had to, in fact, pay tax on the full amount. Whether other persons share interest in the real estate can also factor in, and the occupation of those other persons, their stated intentions. So again, the same thing for the first person. Occupation, intentions, and conduct applies to any other one that's also on the purchase agreement. Factors that motivate the sale of the real estate and evidence of extensive experience in real estate. So if you've done this many times before, much more likely it's an HST situation because it's business income. Well, the courts have considered all the above. The question of motive or intention has been developed the most, and that's why so much of our discussion has been around intention and secondary intention. Here's the secondary intention. It's summarized in this way. Taxpayer's intention at the time of purchase of a real estate is relevant in determining whether a gain on its sale be treated as business income or as a capital gain. It is possible for a taxpayer to have an alternate or secondary intention at the time of acquiring real estate of reselling it at a profit if the main or primary intention is thwarted. If the secondary intention is carried out, any gain realized on the sale will usually be taxed as business income and therefore again subject to HST. In this case, the minister would have to specifically allege that a secondary intention to sell the land in question for a profit was a motivating factor when the property was purchased. So they'd have to produce some sort of evidence to support that contention. Now we're switching to rebates. We touched on these briefly before. Get into some of the numbers now. Generally, you qualify for the federal HST rebate on your home if the price is less than $450,000 and you purchased it for use as your or a relation's primary place of residence, or you constructed or substantially renovated your own home or hired someone else to do it, again, to serve as your or your relation's primary place of residence. And for federal purposes, the rebate refers to the fair market value of the home when the construction is completed is less than $450,000. This is also available if you're a builder who had to account for the HST and the self-supply rules because you sold a residential unit to an individual and leased the land. Or you're a person who had to account for the HST under the self-supply rules because you made an exempt lease of land for residential purposes, such as the rental of a residential lot or a site in a residential trailer park. For the land or site in a trailer park, the fair market value number in question is $112,500. The rental accommodation or land must be intended for long-term use as a residence. You have 2 years to claim the rebate after the base date. The base date is the earliest of the day that is 2 years after the day you or relation first occupied the house after the construction or substantial renovation has begun. The date the construction or substantial renovation is substantially completed, or the date you transfer ownership to the purchaser. So the earliest of those dates, that's when the 2-year clock starts ticking. The way the rebate works is you can claim 36% of the federal portion, which is 5% of the HST, on a new home with a pre-tax price less than or equal to $350,000. When the price is between $350,000 and $450,000, the rebate is gradually clawed back or reduced such that no rebate is available when the purchase price is more than $450,000. The maximum available is $6,300 for the federal. Obviously, many of you are in the greater Toronto area, and any home you buy is going to be over $450,000, and therefore there will be no federal rebate. However, there is an Ontario HST rebate. The rebate is limited to a maximum of $24,000 if you paid HST in the purchase of land and $16,080 if you did not. So you're able to get back 75% of the HST for the Ontario portion of the HST. In other words, the 8% up to a new home purchase amount of 400,000. Again, as we discussed, in the Greater Toronto area, homes are going to be well over 400,000. All this means is you're going to hit the limit of 24,000. So you may be eligible for this new residential rental property rebate if you're a landlord who purchased a newly constructed or substantially renovated residential rental property, built your own, or made an addition to a multi-unit residential rental complex. If you bought the house as an investment and plan to rent it out, you can apply for the rebate immediately, but you'll have to send proof that you closed your deal. And if you sell the investment property within a year, meaning 1 year from closing, not occupancy, you'll have to repay the tax. You need to supply supporting documentation, which includes the agreement of purchase and sale, the APS. You don't have to send in all the appendices, however, the final statement of adjustments, and a copy of the lease, which has to be for a period of at least 1 year. So some key takeaways: HST may or may not apply to income and expenses, as it depends on the type of real estate activity performed. Whether HST applies in an assignment will depend on the circumstances, especially as they relate to your intent. Builders typically must charge HST in a home sale, and the definition of builder for HST purposes is expansive. You may have to charge HST on your assignment of a purchase contract. If HST applies, it will apply to the entire amount charged, including recovery of any deposits, as well as any profit on the assignment. And realistically, there will always be profit unless you're assigning because of a change in your circumstances, in which case you may in fact have to take a loss simply because you have to unload the property. Our next event will be on January 27th, again at 7 p.m. Topic will follow. And let me see if there's any questions in the chat. Doesn't look like there's anything in there, so I guess we just answered the questions as you were watching. If you have more detailed questions or would like to have something discussed on a one-on-one basis, please schedule a free 30-minute session here. There's the link. Appointments are available on the hour and half hour tomorrow and on Tuesday, given Monday, most of us have as a holiday. None of those times are suitable. Please email me to arrange a mutually convenient time. Okay, we're just at the end time, but I would like to quickly go over a little bonus section regarding CRA enforcement. It's relevant to the discussion of HST, which is why I'd like to do it tonight. So CRA has increased its compliance efforts, particularly in areas where speculative activity has increased, i.e., particularly in Vancouver and the Greater Toronto area. A recent budget gave CRA significantly more resources to investigate these transactions because the government felt this was a substantial area of non-compliance. What this means for you is that if you're involved in a pre-construction assignment sale, the likelihood that you'll be subject to CRA scrutiny will be very high. So you need to understand the rules for both the income tax and HST relating to those sales. If your return is selected for an audit, CRA will consider the following factors to determine whether you correctly reported a real estate sale. The type of property sold, how long you owned it, your history of selling similar properties, whether you did any work on the property or you just sold it as is, why you sold the property. We saw some examples of how that could play out in both directions of HST, no HST. Your intention, again, we discussed that at length today. If you're a professional contractor, renovator, speculator, or an individual renovator, you're going to get extra attention from CRA when it comes to property sales. So how they're addressing this issue of non-compliance. So they use a combination of computerized risk assessment tools, analytics, leads, and third-party data to detect and address non-compliance. And they'll audit the files of taxpayers identified as being high risk. Understand that as soon as a buyer of your property registers that property in their name, CRA is automatically notified of the sale. So there's no hiding sales from CRA. The client that I mentioned earlier actually forgot to tell CRA about the sale because they're out of province. Not only was he assessed for income on 100% of the gain because he was offering it for sale within a few weeks of buying it, he was hit with a 50% gross negligence penalty. CRA has identified the following areas of concern. Reported income does not support lifestyle, property flipping, unreported capital gains on the sale of property, unreported capital gains tax on property sold by non-residents, unreported worldwide income. So this would be where you're selling real estate in another country. Unreported HST on the sale of a new or substantially renovated home. And rebates being claimed incorrectly, as they're only available to the builder or the purchaser. So just to quickly look at these in turn, where the reported income does not support the lifestyle, they take into consideration whether your income is sufficient to support your lifestyle, including the cost and maintenance of any real estate in your name. They can establish correlations between your reported income and the lifestyle. The acquisition of expensive assets, such as a high-end home, without an obvious income source can be an indicator of potentially unreported income on income tax returns. So this would typically be people who are working for cash, not reporting the cash as income on their tax return, and yet somehow being able to buy expensive real estate. People who buy and resell homes within a short period for a profit are often engaged in property flipping, as we discussed. CRA has found that some flips are not being reported at all or being reported incorrectly. So this would be people claiming capital gains treatment or perhaps even principal residence exemption, neither one of which would be appropriate. The profits from flipping real estate are generally considered to be fully taxable. There are factors in each case which have to be examined to determine whether it's a business income or capital gain. And that would primarily come down to where your intention changed because of outside circumstances. The three main categories of individuals engaged in property flipping. So the professional contractors, they're rapidly buying and selling at a profit. Speculators, so they buy a property before construction is completed and then assign the right to sell clause that is in the contract to another speculator, or in fact, the final buyer, sometimes called shadow flipping. It can occur actually more than once. And the original seller often does not know that their property has been assigned to another buyer until the closing date. Or individual renovators, they buy real estate, renovate, and live in it for a short time in order to claim the principal residence exemption. And again, none of that is appropriate. Unreported capital gains on the sale of property. If you make a profit, you may in fact have a capital gain to report. Whether it's exempt or not, capital gains are reported on Schedule 3 of the personal tax return. If you own more than one property at any given time, only one property is eligible for the principal residence capital gains exemption for any given year. So by definition, if you sell two properties in the year, one of them has to be taxable, even if it's as a capital gain. There's some more information you can find here concerning the designation of a property as a principal residence. The next issue was unreported capital gains tax on properties sold by non-resident. So a non-resident who invests in property in Canada is liable to pay capital gains tax on the profits from the sale of that property. Generally speaking, they're not going to be eligible for the principal residence exemption, and therefore they will owe that tax. It's the responsibility of the buyer of the property actually to know whether the seller is a Canadian resident. Usually the attorneys or notaries involved have the responsibility to complete that verification. A purchaser who buys a property from a non-resident seller should request a certificate of compliance issued by CRA prior to releasing the funds. If not, the purchaser actually could be held liable to pay CRA any unpaid income tax. So that's why you want to be very careful. And typically there's a declaration in the agreement of purchase and sale that the seller is verifying that they're in fact not a non-resident. So this issue is not something you'd have to worry about. You just want to make sure that's in your agreement of purchase. Unreported worldwide income. Residency status is what determines your tax status. For example, a citizen of a country other than Canada who has significant residential ties in Canada may be deemed to be a resident of Canada, which means as a resident of Canada, they have to report their worldwide income to CRA, which would include sale of any foreign real estate. Non-residents only have to report their Canadian source income. There's many factors that are looked at, as I mentioned, residential ties, purpose and duration of visits outside Canada, there's social and economic ties outside of Canada, and there's a reference here to determine your individual resident status. And again, we're talking about for tax purposes. Unreported HST in the sale of a newer or substantially renovated home. Generally, the builder must collect HST when the home is sold and remit that tax to CRA. If they lease or rent the new home, they're deemed to have sold the home to themselves, which means the HST is payable at once on the fair market value of the home, and the builder must remit that tax to CRA. In most cases, the sale of used housing is in fact exempt from HST. The tax rebates are available to the builder or the purchaser. As we looked at, there are two types of rebates: the new housing rebate and the new residential rental property rebate. The amounts are exactly the same under either rebate. The only difference is when you can apply for it. So if you will be living in the property as your personal principal residence, you apply for it as you buy it. The builder gives you credit for it, as we discussed, and therefore you paying the purchase price net of that rebate. If, however, you're renting the property, you have to have the 1 year plus lease agreement before you can claim the new residential rental property rebate and set it in along with the other documentation we discussed, which was the agreement of purchase and sale and the final statement of adjustments. If your intention is to flip the property, however, you may not be eligible for any rebate, which means you must charge and remit HST on the sale of the property. One of the main conditions for the rebate to be available is you must buy or build the house for use as your or your relation's primary place of residence. If you buy or build a new house in Canada, but your primary residence is outside of Canada, then your house in Canada would be a secondary place of residence and actually would not qualify for the new housing rebate. Just to give you some sense of what all this extra auditing has netted, you have a total of 47,481 files of various taxpayers assessed in Ontario, and the recovery was 950 million in additional taxes. Now, if you look at this, by far, the vast majority of this work was done around the rebates. So in Ontario, that is the number one thing when it comes to real estate. Make sure you get those rebates accounted for properly. The dollar figures include the penalties. By comparison, in British Columbia, the vast majority of the audit activity in terms of dollars was around income tax, even though the number of files was higher for HST, just like it was in Ontario. The dollar figure of recovery was much higher for the income tax. CRA applies a gross negligence penalty of 50% of additional tax payable if a taxpayer knowingly makes a false statement when filing a return. And a false statement would include not reporting income that should have been reported. And so during a recent approximately 6-year period, they applied 2,639 penalties totaling 232 million. All this to say that you want to make sure at the very least you avoid this penalty by at least having a good faith belief that you're reporting it correctly, even if it turns out you're mistaken. And that's the end of our presentation. As I see no more questions, I will thank you for watching our presentation. I look forward to seeing you on the last Thursday of January, which is the 27th. Again, we will be starting at 7 p.m. and hope you have a very happy new year. And that's it for now. Bye.